Here in this video, we will discuss what happened today in Tesla stock, including option activity, the short positionings, were short sellers covering or adding to short positions today, and much more, including the Federal Reserve's FOMC Minutes. This is basically like a transcript of the last FOMC meeting, not word for word, but it's a report. It's essentially the things they want you to know from the internal meetings of the last Fed meeting. And it's all but confirmed that the Fed is now acting in a political nature, taking into account theoreticals in making decisions today, which could prove to be a big mistake. And the data that we got out today at 3 p.m. with the consumer credit change shows that, yeah, that could be a problem. We'll discuss that throughout this video, what the Fed said, and much more. We will also take a look at the technicals for Tesla stock and what could be coming next for markets, with a big catalyst on Friday, that is the jobs report. I do want to preference this video with saying sometimes I share my opinions, and I'm proud to share my opinions, whether I'm right or wrong. But keep in mind, these are only opinions, they are not fact, and I am subject to be wrong. So do not trade money that you are in need of. Money that you need, my friend, is cursed. Do not do it. Do not YOLO your portfolio based on anything I say in any videos. This is not financial advice, even though I am currently studying and about to take the Series 65. This is not personalized financial advice. First and foremost, let's start with some of the main highlights from the Fed minutes today. Okay, first and foremost, let's go over the FOMC minutes. First headline here says a number of participants indicated they had incorporated placeholder assumptions regarding potential trade and immigration policy changes into their projections. Participants expected inflation to keep moving towards 2%, but effects of potential trade and immigration policy changes suggested that the process could take longer than previously anticipated. Participants indicated if data came in about as expected, it would be appropriate to continue to move gradually towards a more neutral policy stance. Fed staff projected slightly lower GDP growth and a bit higher unemployment rate than the previous baseline forecast after incorporating recent data and placeholder assumptions of potential policy changes from the incoming administration. Some participants said there was merit in keeping rates unchanged at that meeting, citing higher risks of persistently elevated inflation. But the vast majority of participants saw it as appropriate to lower the target range by 25 basis points at the December 18th Fed meeting. Now, I actually love this, and let me tell you why, okay? I love the Fed that's starting to incorporate hypotheticals, because that means they're kind of like conditioning the markets already that they're going to have to adjust their policy based on what could be higher inflation based on theoretical policies. Let me explain something as clearly as possible. When you're set up kind of already expecting something negative to happen, you could be surprised a lot easier. Imagine a scenario where we get, let's say, a 10% blanket tariff that has a one-time maybe boost in inflation. I don't really buy the whole tariff's gonna boost inflation thing, because people are not really willing to take on higher prices right now. People are kind of revolting to that, and I don't think the internals of our economy are actually that good. I think we have certain areas of strengths and weaknesses, but generally speaking, go talk to people. They're not gonna like prices going higher, and I think people will switch to alternatives when that happens. For an example, if a gallon of milk, and just to be as generic as possible, in I can't even think of like the name brand milk, but it'll come to me in a second when it doesn't even matter anymore, is, let's say, $5 a gallon, but a company, Kroger brand, for an example, is $3.50 a gallon. People are gonna just trade down to off-brand, right? And that could happen on a larger scale. Thus, I don't really buy the whole, inflation argument. When people stop buying that more expensive product and trade down, then that more expensive product prices are going to fall or just not go up in general because they're not seeing demand with that. If demand falls as companies raise prices, they're not going to raise prices. They're going to take it in the margin if they have to. So that's first and foremost. I don't really buy the whole tariffs are going to cause inflation thing. Of course, if there's like 50% tariffs on China, 30% tariffs on China, 25% tariffs on China, and there is literally no choice from companies to raise prices on a countrywide level, then there will obviously be inflation because there's some things you have to buy you cannot get around not buying. But I don't buy the whole tariff situation will cause inflation. Now, same is true with immigration. Okay, the Fed is assuming a lot of deportations. Okay, we don't know if that's going to happen, and we don't know what the actual effects of that will be. Now, a lot of deportations will cause recession. That will not be good. I think Trump's kind of bound to this narrative. Remember this throughout all of 2025 for the next 4 years, okay? Trump can only do something that helps the economy, okay? Trump's not going to do something that destroys his legacy, that ends the bull market, that knowingly pushes us into a recession. The first inkling of, oh crap, this was a bad idea, it will be reversed on, okay? So, I don't like the idea of the Fed incorporating theoreticals into their policy decisions, but I do think ultimately it will be bullish for markets. If we've all come to expect higher inflation, what happens coming mid-year when inflation is undershooting to the downside, growth is leveling out or starting to fall? What happens in that scenario? The Fed cuts rates a lot, and that is not something that is priced in, and that is a tail for our markets. I would say a tail risk, a tail end catalyst that is unexpected that could push markets higher in 2025. So I actually think the Fed, via all their negative commentary, theoretical kind of modeling they're doing today, is setting us up for larger gains throughout 2025. Now, following this Fed Minutes report today, you want to see the biggest slap in the face to the Fed, to all of the individuals talking about higher inflation and this great economy. Consumer credit change dropped $7.49 billion in November from $19.24 billion in October. Okay, so what that means is in October, there was $19.24 billion added in, could be credit card debt, it could be increased lines of credit, okay? And now you're down $7.5 billion. This has only happened 3 times or 3 months since the crash of the Rona, okay? When obviously the economy was in big distress, okay? This happened in November 2024, like we just said, August of 2023, and a little bit in May of 2023. You felt less than $1 billion there, but August of 2023 was a drawdown of $14.4 billion. So really excluding May, this has happened 2 times in the last almost 5 years now. Okay, this is a bad sign for the economy, okay? That means people are actually drawing down their credit lines. Like, they're not using as much credit. Maybe it's banks kind of taking back some of the credit that they had available. This is a bad sign for the economy. Now, is this the end-all be-all? We're going into recession, sell everything? No. But this is a pretty good indicator that the Fed's not going to be able to be as, nonchalant about holding rates where they are for as long as they expect to. Because get this, Wall Street was actually expecting a credit change of $14 billion positive. So instead of $14 billion positive, came in at negative $7.5 billion. That is an upset of $21.5 billion versus expectation. Yeah, that's a huge problem. Now, before we get into Tesla stock specifically, what happened today, the option activity, short positioning, my expectations going ahead, and the technicals, I do want to say that tomorrow markets are closed, so we're going to have some pretty special videos coming out as well. We are still expected to get some data, though, that will be coming out, like Challenger job cuts at 8:30 in the morning tomorrow. Fed Harker will speak at 9 a.m., you got some bond auctions, Fed Barkin, Fed Schmidt, Fed Bowman will also be speaking tomorrow. Following the consumer credit change today, I'm very curious to what they say in their speeches. Because, again, it's not all the time that this sucker goes negative, okay, on a month-over-month basis. And it's not a great sign when it does. If you recall August, September, October 2023 for markets, oh yeah, let's go look back at that time for anyone that does not remember. I mean, markets were in a pretty nice drawdown. Okay, from see the highs in July to the low on October 27th, the S&P fell about 11%. That was a correction. Okay, part of that had to do with a weakening economy at the time. Markets are back open on Friday. We are going to get your non-farm payrolls report, expecting about 150,000 job ads or so. The estimates are going to vary all over the place, as high as 200,000, as low as 150,000. Somewhere in the middle is basically consensus. Unemployment rate is expected to tick upwards to 4.30%. It's actually at what, 4.25%, and the high of this cycle so far, which was a couple of months ago, was 4.27%. So if we break above that, that's going to be a new high on the unemployment rate, and that again would kind of push back on the Fed staying higher for longer and pausing on their rate cutting efforts. Now, you will also get the Michigan Consumer Sentiment Survey that will be coming out. You have 5-year inflation expectations, 1-year inflation expectations, consumer expectations, and current conditions that will be coming out as kind of subcomponents of this report that markets will also be paying very close attention to. I am firmly expecting that Friday's jobs report, we're going to get a pretty volatile move in markets. I think we could see a big up day or a big down day, given how markets kind of are positioning right now. The Russell had a bad day today. Small caps have had a really bad couple of weeks. You've seen this risk off narrative in markets really ever since December 18th. And yeah, that could get a whole lot worse here soon, or maybe Friday could confirm that maybe the economy is not as strong as we think. Maybe inflation shouldn't be such an issue, right? Inflation tends to be high when the economy is good, and comes down when the economy is not as good. On the day today, 34% of stocks are trading above their 50-day moving average, so 66% of stocks are in an active decline. Okay, anytime this percent of stocks are in a decline, you want to be buying the dip on that. Now, at the same time, only 50% of the S&P is above its 200-day moving average. That is the lowest level in 14 months. Clearly, I mean, when things are this negative, you want to be buying that unless we are entering into a new bear market, in which at this point doesn't seem likely. But hey, I guess if everyone knew when a bear market started, I mean, they would sell out long beforehand. Okay, so anything's possible there. Let me know down below in the comment section if you think this is the start of a new bear market. If you do not think it's the start of a new bear market, history would serve you very well in saying this is probably when you want to start buying the dip. And that's part of the logic in the videos that I've put out in the last couple of days, that this is probably time to start buying the dip in Tesla stock and even in the broader markets. CNN's Fear and Greed Index supports that as well, sitting on the low side of fear at 33. I mean, things are far from optimistic here, guys. They're very negative. And I think, you know, with the jobs report on Friday, you're probably more likely to rally than not, given we're already so negative. I think we're kind of vulnerable for a reversal rally. We've kind of been falling recently. It's not going to take too much to get that reversal to the upside. Now, short sellers today, to some people's surprise, actually covered almost 900,000 shares in their Tesla short positions. So who knows if this is kind of a precursor towards a bottoming eventual rally again to the upside, but almost 1 million shares did cover on short positions. In fact, 1.22 million shares covered on short positions. 343,000 shares were sold short today. So on net, you had about 900,000 shares that were covered on. That's a good sign. I mean, is it like the end all be all? This is the bottom for Tesla? No. But it is a good sign that people are using this opportunity, as Tesla is now below $400, to cover on their short positions. Now, short interest of free float as a whole at 2.89%. $31.82 billion sold short in Tesla, totaling 80.69 million shares currently sold short. Option activity in Tesla stock today was pretty positive, 63% positive order value. I'll take that. It's not the greatest. It's definitely not the worst. The dollar amount, though, was on the low side. You had 121 different trades totaling $118 million. And I say that's on the low side. That's like higher than 98% of other stocks on our markets. You don't see option activity like that on too many other stocks, only like other big tech names. But for Tesla recently, this is on the low side. Now here for Friday's expiration, you had volume today of 55.62% calls and 44.38% puts. As far as the technicals on Tesla today, again, it was a pretty good day. You're still kind of in, after hours trading here, up around 0.5% or so. Perfect technical trading though, okay? So you came up to this trend line here, you got some resistance, okay? This is the gap fill level, okay? So this is the level you want to break out above. You got resistance there at about 402 today. On the downside, it's the trend line here that you've seen a lot of support at recently. What happened? You bounced literally at the penny on both of these trend lines. So you're trading right in the middle here. You're going to get a break to the upside or the downside of this, likely on Friday. I would be surprised if that does not happen on Friday. I think you get a break to the upside because the jobs report may come in a little bit on the weaker side. Mix that with some of the recent data we've gotten, like consumer credit change. You could be due for a bit of a bounce. Also, you have the port strike that looms large on January 15th. If that situation is resolved over this weekend, which they've been having meetings for the past couple of days, that could also be a positive catalyst as well. I think that's some of the inflation fear as well right now, is what happens if the port strike down, mix that with tariffs, mix that with strong economy. And I put that in parentheses because it's not all strong. It's kind of a mixed bag across the board, right? Depending on what income group you're looking at or what sectors of the economy you're looking at. So mix that together. I think we're expecting a lot of bad, and we could be due for a little bit of good. And it's weird because good news could come in the form of a weaker jobs report. Maybe a jobs report that shows the unemployment rate is going up, maybe for the right reasons. Okay, maybe that's productivity going higher, but not as many jobs being added, right? That would be the unemployment rate going up for perhaps the right reason, but still the unemployment rate going up nonetheless. So, I think it's a great time to buy the dip in Tesla. I think this is an opportunity. Again, the RSI is at 49.18. You're neutral on Tesla. You've seen this correction. I mean, anytime you've bought Tesla down 20+%, you've made money. Every single time you bought the dip in Tesla, you've made money. I mean, from December 18th until now, that's not exactly the case. But any other time throughout Tesla's history, if you had bought the dip and held, you made a lot of money. I don't think this time is any different. We heard from Elon Musk today that they're already doing unsupervised FSD rides internally with employees, and that's going to be launching still as expected this year. So I think there's a lot of reasons to be bullish on Tesla. I think the markets have gotten too negative, and eventually, probably on Friday, you're going to see a reverse to some of the bearishness we've seen. Just my opinions, again, and I don't know where that's going to take Tesla. probably back to about that 420 level. 20-day moving average, still an important level at about $425 per share. That's where you're going to find some resistance. You want to break out above that into the 460s or so. But what a weaker than expected jobs report would really do from a tactical perspective, it would bring down the bond yields for anyone that's curious. Their 10-year treasury yields at 4.67%. They've been breaking out recently. It could bring these down, which would really take some of the pressure off of markets and allow for Tesla to do well. It would allow for the rest of the markets to do well, because when rates go up, Tesla's cost in actually buying down those rates is more expensive. Okay, that's why Tesla's a very interest rate sensitive company, because their consumer base, I mean, cars are very interest rate sensitive. People 80% of the time get loans to buy cars. When loans are more expensive, that's not good for your auto business. Although I think it's going to turn into more of a robotics play and, you know, AI play this year. Interest rates are still very important for Tesla. So let me know what you guys think about this down below in the comment section. That's going to go ahead and do it for this video. We have a lot more to talk about tomorrow, and I look forward to that. Hopefully you guys come join us on the channel for a little Thursday off from the markets. It's to honor Jimmy Carter, if you did not know. That's why markets are closed tomorrow. So thank you for watching. Enjoy the rest of your day, and I will see you in the next one.